Welcome back for my final daily report market analysis video with me, Richard Perry, market analyst at Hantec. On Wednesday, the 29th of April, looking at gold, which has continued this little corrective move lower in the past few sessions. We've seen a downside break of 1702, didn't hold into the close, but we've seen another dip below that level today, and it certainly looks that this pivot line that had been holding is coming under increasing pressure. But look at the momentum indicators now. The stochastics pulling lower. The MACD lines with a bear cross. Last time we saw that situation wasn't all that pretty, was it, for the gold price? So we need to be very cautious about this, the outlook for now. It just seems as though that at the near term it's consolidating really. You can see here on the hourly chart we're sort of gravitating around 1702 today, 1702, and momentum indicators on the hourly are basically consolidating. You do have the Federal Reserve meeting tonight, which will be in the minds of traders certainly, and hence why we're sort of gravitating around that mid-range pivot. 1691 was the reaction that we saw yesterday on a couple of occasions. A little bit of a support building there now, these old breakout levels. So that's essentially the line of support which I think is preventing a downside break and a move towards 1660 now, which would continue, if I sort of explain out this rate, which would continue this sort of waving consolidation back lower under the 1702, which is essentially the midpoint of the range. Yeah, you look at hourly momentum. Essentially it's sort of been neutralized a little bit this morning, but still with a marginal corrective bias, you would argue, under 60, around neutral on MACD, but having been below it. So you could argue that certainly the bulls have not got the momentum on this one anymore, and they're sort of consolidating in front of the Fed, but there is a slight corrective bias that's starting to take hold, and I've been positive for a while on gold, looking to buy into weakness, and I'm still that way inclined really. You're trading above all the moving averages, which are rising, so that's an encouragement, and you're not selling sharply down. But just for now, you need to be a little bit cautious because this little run lower could continue. It could sort of be dragged back into the 1660s, 1670s perhaps. So that's a little bit of a concern for me. But essentially, I'm still positive on gold on a medium-term basis. I still think that buying into weakness is the way to play gold. But just now on a near-term basis, having rolled over with these negative candles, I'm just sort of taking a step back, turning neutral, and waiting for how the Fed can affect gold. Because certainly if the Fed takes on more of a yield curve control policy or hints towards it, I think that would be gold positive because it just keeps yields depressed for ever longer, and I think that is a positive environment for gold. So with that in mind, I wish you good luck in your trading today. Click here to subscribe to our analysis videos and go to our website where you can sign up for our webinar.